Right, from the entire BCI team, good morning to our wonderful audience and welcome back to Boutiques on Wednesdays. With US bond yields still on the rise, global and local markets retracted in September. It's been a very tough one. Concerns around the health of the Chinese economy remains, especially the property sector, and that also weighed in on emerging market indices, including South Africa. Geopolitics are fragile, to say the least, and recently, the past week or the past few days, we've seen that escalation in that, with the recent conflict in Israel adding to very high levels of uncertainty. In SA, we're seeing high population growth, but low to no economic growth. So technically, it means that we are going backwards besides the barrage of headwinds that faces SA. Despite this, for the past year, SA equities showed remarkable resilience in a very tough macro environment. So you have to wonder if there's more to the whole story than what meets the eye. SA Inc. especially are trading at significant discounts, and there could be a lot of value to be unlocked despite all the headwinds we are faced with. With that said, it is my great pleasure to welcome Safs Naker from Vunani Fund Managers here to look at SA Equity and how they manage that in the Vunani BCI Equity Fund. Safs, thank you so much for joining us this morning. Interesting times indeed, especially to talk about things like SA Equity, but things are always not as it seems, even if we look at our markets of late and resources especially. One would have thought things would have gone the other way, but it's not the case. I'm really looking forward to your presentation, what Vunani is all about, and how you see the world and the SA equity space.
Thanks, Eugene. Yeah, interesting times indeed. Thanks for the opportunity to speak to your team. I'll share my slides and then take it from there.
Yep.
Just let me know when you can see them.
It's coming through. Full screen mode, perfect. Yep, ready to go.
Perfect. I'll try to stick to the time. I'm usually not really good at these timekeeping, but just shout when you want me to stop. Okay, so I'll give you a very quick overview of Vunani Fund Managers, where we come from, what we do, and then jump straight into domestic equities. So we've been around for 22 years. I'll go through a bit of the chronology of events, 46 billion under management, and all the usual sort of paraphernalia that you'll see with most investment companies. So I'm not going to spend a lot of time on the slide, but a sizable business that's been around for multiple decades. Many of you may recall a business called Peregrine Quants. I mean, that's the founding sort of infrastructure and business that gave birth to Vunani Fund Managers. And that's the chronology of events over a period of time. We've got a very long history in managing multi-asset and across the asset spectrum in different asset classes, but really the business got born out of multi-asset. And in 2023 or 2022, we launched a BCI multi-asset fund. So about 3 years ago, we launched co-named funds on the BCI platform, but we've been managing funds in the CIS space for multiple decades as well. In terms of team, I mean, this is what the team looks like. You may recognize some of these names. You probably have listened or heard Rowan speak. I know Rory has been on this platform as well. But we do have a full spectrum of asset classes that we cover and quite a sort of experienced team across what we do. The one sort of untold gem in the stable is that we've got quite a strong passive capability. In fact, many of the indices that you see on the JSE has some of their foundings in the quants technology that was developed by Peregrine Quants back in the day. So yeah, lots of capability, experience, and team to support what we do. If you look at capabilities in terms of track record, you know, domestic equities, you know, got over a 12, 13-year track record, and effectively, you know, the same sort of capability with a much more focused view gets demonstrated in the BCI equity fund, which we will talk a bit about later. Over a 15-year nearly a 10-year track record and a bit more in global equities. Recently also launched a dollar fund off an Irish platform. So global macro has been going for quite a while. Fixed income, also around 15 years of track record. And you've heard Joan speak. We run a plethora of funds in this space, but in the BCI sort of universe, BCI bond and short-term interest fund. And in the near term, probably looking to do something a bit different, potentially on the global space as well. And then multi-asset strategies, probably the longest asset class that we've managed. CPI plus 5 dates back all the way to the turn of the century, when we started managing these funds, and really gave birth to a lot of the product sets that we manage now. So even though the BCI multi-asset fund has a very short track record, the capability has sat in-house for many years. So let's get into domestic equities. So before we start in domestic equities, we can get the usual sort of stuff out the way. South Africa is a terrible place. Load shedding is a terrible thing. There's corruption. There's no growth. Eskom's a problem. Transnet's a problem. These are all things we know. I think if you look through these issues, it's really been priced into the market at the moment. So what do we do at Vunani Fund Managers when we look at equities, domestic equities? We really try to unpack, in terms of our philosophy and approach, try to unpack, what's been priced into the market, and looking for companies that really have managed through multiple cycles, ability to generate returns, strong returns, through both up and down cycles, strong balance sheets, and good management. So you're looking for good companies that are being priced as if the persistency of bad news will be permanent. So as Eugene started out as saying, SA Inc. is actually trading at significant discounts, and we find those valuations extremely attractive. So ultimately, that's what we're trying to capture in the process, and we're looking for businesses that can, where the market is pricing in perpetual bad news, which can surprise to the upside. And that upside surprise actually is very fertile ground for alpha generation as we go forward. And we don't just say this and not back it up with sort of fundamental and real sort of data. So this is looking back over the last 60 plus years on the all share and decomposing the returns into what drives returns into its various components: earnings growth, PE rating changes, and dividend growth. So if you look at the far right, 60 plus 40, 50 years, we know all economic research or all academic research will tell you that earnings growth drive returns. And that's absolutely true in the long run. But in the 0 to 5 year bucket, what you tend to find is that ratings changes and earnings growth surprises, or both upside and downside surprises, actually have an outsized impact on your return. So ultimately, that in your process is what we're trying to capture. We're trying to capture where the valuations are so depressed that any positive announcement in terms of earnings will have a massive re-rating effect. And that gives you the opportunity to generate outsized returns. Bear in mind that even though we all are long-term fund managers or long-term investors, the long term is made up of multiple short-term periods. So ultimately, what you're trying to do is compound your returns incrementally over multiple periods to generate that outperformance over the long term. Another thing that people often refer to is, buying assets at low valuations. So low PEs. Again, if you decompose low PEs and subsequent returns, you notice that assets that trade at depressed valuations, if you look at subsequent 5-year returns, they tend to be exceptional. However, there's one caveat to this. The understanding is that those companies will still generate returns. If you buy a company at a low PE where returns are going to be negative for the next 5 to 10 years, it's not a cheap business. It's not going to generate your outsized returns. So ultimately, that is what we're trying to capture. And that is the process of trying to build a portfolio that will generate returns that will outperform the market. Yes, there will be negative news. Yes, there will be sentiment that is extremely bearish. But that typically gets priced into the valuations. And at that point, you need to look and truly asked whether the business can sustain its earnings and its ability to generate returns. And within the SA market, there are phenomenal opportunities at the moment. Businesses that are priced as if we're going into a global financial crisis. And if that doesn't materialize, the potential for outsized return is huge. So ultimately, that research process filters through a portfolio construction process and into the portfolio. There's a whole host of sort of processes in between in terms of balancing risk and return and understanding best ideas and how that actually generates the ultimate portfolio. And ultimately, the concentration and risk and the balancing of risk and rewards in the portfolio. This is not a once-off process, it's a reiterative process. So we do intend to look at the portfolio every month. We do look at our positioning, and we do try to focus positioning. So this is not a portfolio that hugs the benchmark. It's not one that tries to be index enhancing. It is an active portfolio. There are active positions. We do take focused risk positions, and it does look to outperform the market over the long term. So ultimately, the rigor of the research process is trying to unpack how does earnings develop over the near term? What drives it? Is it margin growth? Is it underlying fundamentals? Is it macro rate cycles? And then testing how that assumptions play out through a host of scenarios. We try and incorporate both a strong bottom-up fundamental analysis with a macro lens as well. So the bottom-up fundamental analysis does incorporate some of the macro views. So what do we think about global interest rates? Are we at the peak of the cycle? And that comes through in the consensus numbers. And that process is really tested through various sort of iterations in the research process, but also in the portfolio construction process. So we've spoken about sort of valuations and what's priced in. Ultimately, we can, and we use PE as an example, but it's not the only valuation metric we use. But if you look at valuation metrics, if you look at the screen every day, you can see what retailers, industrials, resource companies trade at. We don't focus so much at what they trade at, but what's been priced into that number, i.e., if you unpack that number into its component parts, what's been priced in? Growth forever at a negative growth rate or depressed levels, cost of equity or discount rates at 16 or 17%. How does that filter into long-term interest rates, inflation? And then also the earnings profile. What does the company do? Can it sustain its distributions? Is it able to pay? Is it going to increase its distributions or decrease? And then try to figure out what's being priced in. Ultimately, we know that companies go through cycles. We know that valuations go through cycles. And if a company is pricing in a perpetual bad outcome, that may be true in the medium term if an industry and a company is in its sunset phase. But it's not necessarily true for all companies that trade at low valuations. And you've seen that of late in some of the domestic counters. They've re-rated quite sharply, and they still trade at significant discounts. So that is the crux of what we do in terms of trying to understand the businesses and how we kind of construct portfolios. I can probably spend another hour talking you through the process and philosophy, but I'll get straight into the portfolio, and then we can talk about sort of specific questions and how we structure the portfolio. So when you look at the portfolio that we've got, ultimately what we're trying to do is look at the best ideas and try to balance risk and reward. So the exposures within the portfolio, we do have quite a large tilt to financials, and that does have a predominantly banking flavor. So the big four banks, we do have some insurance companies in there as well. We've tended to shy away from a lot of the general financials. And then resource counters, we went into this cycle with quite a strong weight in resources, particularly precious metals and PGMs. So that remains a focus in the portfolio. And then over the last month or so, we've started building out our property exposure. What might surprise you, or maybe it doesn't surprise you, is that we've got a big underweight to technology. So we have about a 7 or 8% underweight. to the combination of Process and Naspers, and we probably can get into questions on that. I suspect it may be a bit counterintuitive to a lot of people who say it's a big discount play because of discount to NAV. But the governance and the management issues in the business have left us less excited about what they're busy trying to do. And then industrials, predominantly, we've got exposure to SA retail, so big retail players in South Africa, and then recently started building a position in telcos. So that kind of gives you a flavor, and we'll get into the individual counters in that space as well. So this just shows you the active position. So this is relative to the benchmark weight, which is CAPSWIC. So we benchmark for the portfolio is J403. So quite a big active position in financials and real estate and this consumer discretionary, which is predominantly your retailers and your food retailers. So the likes of Spar and Pick n Pay. And then discretionary retailers are your Truworths, Foschini, Mr. Price. Real estate, we've started building that position of late. Again, we probably think we're close to the top of the interest rate cycles, and property counters are showing quite a significant value opportunity. So even though we've got quite a strong position in basic materials, on an overall basis, we about 3% overweight the sector. And then the big underweights, if you cast your eye to the left of the chart, is the likes of consumer staples. So we don't hold any Richemont, we don't hold any BTI, a lot of the Rand hedge counters. So it is what it says on the box. A lot of these Rand hedge counters are extremely well priced. They price for perpetual growth, and you've started to see some cracks in those counters coming through. LVMH reported last night, and you're starting to see a significant slowdown in luxury goods. So that counters have detracted, and we do think of the valuation gap between the Rand hedge counters and the domestic counters are so significant that any degree of positive news would actually cause quite a strong rally in domestic counters. The fundamentals and the businesses remain very well managed. Balance sheets remain exceptionally strong. Cash flow generation, even where we are at the moment, they're still generating decent cash flows. And you've seen that in the interim results that's come through in June. And then technology, I spoke about Naspers and Process, still a significant underweight to those two counters. Again, if you go through the logic of how we think about that business, if you strip out Tencent out of that business, the rump of the business has not performed. It's absorbed exceptional amounts of capital. It's not cash generative. And one thing people often forget with Naspers and Process is that you've got to look at the cash flow statement and not the income statement. The income statement is proportionally consolidated. The cash flow statement actually tells you a very different story. The business for the last couple of years has not been able to generate sufficient cash to pay its own interest and taxes without the dividend from Tencent. So while the earnings look phenomenal, if you strip out the Tencent earnings, it's actually the rump of the business is actually not doing great. And they've done an exceptional amount of work trying to unlock the discount by going offshore. And that has cost an exceptional amount of money. And recently, Bob van Dijk, who was the CEO, got removed very surreptitiously, and what we think was rather unfortunate circumstances rather than through a proper succession plan. But yeah, I mean, that's the shape of the portfolio. When you look at active share, again, you can see across the portfolio, there's a very strong, I mean, if you look at the counters on the right, there's probably names you would recognize. Old Mutual, ABSA, Redefined, Growth Point, Truworths. So a lot of the big sort of industrial, financial, property companies in South Africa. And that does tend to be the flavor of the portfolio. We do tend to look at the larger and mid-cap counters. It's not a portfolio that you will find a lot of small-cap counters in there. And then the counters that we are significantly underweight are typically the ones that trade at significant premium. So FirstRand trades at a massive premium to the other banks. When I say massive, I mean it trades at about 10 times. The other banks trade at about 6 to 7 times historic earnings. On a forward basis, it's probably trading at the big four, excluding FirstRand, probably trade at about 5 times earnings. If 2023 earnings are probably up mid teens. So yeah, and then if you look at the counters on the left, you'll also see the likes of BTI, Richemont, Bidcorp. It's probably all the counters that have been in favor for the last 2 to 3 years because of their foreign earnings. We think that cycle is coming to an end. We think that the higher rates will start to bite as we go into the end of 2023 and in 2024. And expectations for these companies are extremely elevated. So growth still growing at the high single digit, and multiples probably in the mid teens to upper teens. So we think those multiples are extremely negative for future return profiles. So we prefer to be in the domestic counters. If you look at the portfolio, it's got a domestic tilt to it. And that's not because of some sort of macro overlay, but rather because when we look at the bottom-up fundamentals of these businesses, they do offer phenomenal values. They've been businesses that's been around for multiple decades. In the case of Old Mutual, they've been over a century. So they've been through cycles. They're very well capitalized. They know how to manage the business. And they're almost systemic to South Africa. So we think those valuations offer fertile ground for returns in the near term. When you look at risk, we do think about risk as how we manage our tracking errors and how we look at positioning relative across the portfolios. So we try to balance risk as not to have one or two counters contribute to all the risk in the portfolio. So across the portfolio, the consumer discretionaries as a sector is the biggest single contributor as a sector to our risk. And that's largely the positioning in the likes of Truist, Foschini, and Mr. Price. And they're not holding counters like BTI and Richemont that have altered that sort of composure. And then financials, technology are probably on an equal footing. So yeah, a different way to look at it. Would you prefer financials at a 6 times multiple, or technology counters, Naspers and Prosus, with its exposure to China and a slowing global economy? So we do spend a lot of time trying to balance risk and return. It's not a all or nothing portfolio, but it does have very focused positions, and it is aimed at individuals who wants exposure to SA Inc. The way the SA market is structured at the moment is that you could have a SA portfolio that is loaded with offshore counters and actually has an offshore or rand hedge flavor rather than a domestic flavor. We have an underweight to rand hedge counters and a much more domestic focus in the portfolio. And we believe that, we're probably closer to the end of the rate cycle, specifically in SA. I think the global rate cycle is at a peak. Post the event of the past week or last couple of days, I find it highly unlikely that the Fed will raise rates. Recent Fed speakers have also spoken about sort of potentially going on hold, that higher rates in their bond markets are holding or doing the job for them. So perhaps we're at the peak of those rate cycles. If you look at domestic inflation, we're already within our target band. So as long as we don't have an energy spike with commodities and oil or a rand blowout, we're probably looking at Q1 next year, the start of the rate cutting cycle in South Africa. I would also just point out that history doesn't favor a soft landing for the US economy. It's possible, but it's probably not a probable event. Every downturn that the US has gone in, everyone's always thought it's going to have a soft landing. If you had rates increase at the rate it has gone, there's a more than likely probability that it's not a soft landing. But commentators would have you believe that we're in it for a soft landing. So against that backdrop, I think domestic counters offer a massive opportunity. If valuations re-rate, you could end up with that chart that I showed you right at the beginning, where you're starting with valuations sub 10. Your next 5-year returns could actually be double digit. What do you need for that to happen? You need a bit of normalization in activity. You need some positive earnings trajectories to take hold in South Africa, and you need sentiment to change. So for the last 10 years, while the globe was in a low interest rate environment, it was common cause for everyone to take money offshore. And even recently, we've changed our regulations to take 45% of your assets offshore. That is all great, but perhaps it's time to bring some assets home. At the currency where it is and valuations where they are, you may look back and wonder if you've missed a good opportunity to generate outsized returns. So I guess with that, I will leave it there and then open up for questions.
Subs, thank you very much for that. Very insightful indeed. I mean, a lot of information covered in a very short space of time. I don't see any questions from the audience. You're more than welcome to post questions if you want. But Subs, from my side, just very quickly, you and I had a very brief discussion before we started the session. You know, and it almost boils down to not to be led by what macros or macro events in the world, especially if we look at, you know, the recent week and more so the past year. We all know the narrative's been all over the place. Everybody's been wrong in terms of forecasting. We all feel the jitters, you know, when we look at geopolitics, when we look at the SA environment. But the recent week's been very strange indeed. I mean, despite all this conflict and the stuff erupting in Israel, I would have thought that resources would have behaved very differently, but it's actually done quite well. You've got a big chunky allocation in your portfolio, as you've shown, to resources. You include PGMs as well. But what's your views on resources going forward, especially with China still in the doldrums, the economy not really unlocking, a strong dollar at the moment? Why such a big chunk to resources, and why do you still hold things like PGMs?
Yeah, good question. So let's start with the PGMs. What do we know? We do know that we have to transition to a greener economy. We know that the PGMs are required for that transition. Metals are required for that transition. We could argue, is it going to start next year or the following year? But we know it's going to start at some point. There's going to be a demand for cleaner energy. If you think about whether you're going to go solar or green or gas in terms of what you need to produce, you do need to have catalytic converters. You do need to have hydrogen in your economy in terms of producing energy. All of these technologies do require some degree of PGMs. Now, that demand has tapered off quite sharply over the last while. But if you look at the PGM companies themselves, they're not budgeting and they're not planning on commodity prices at elevated levels. In fact, they've cut costs, they've reduced capex expenditure. Even at these levels, they still generate free cash flows. If you look at their balance sheets are actually ungeared at the moment. So they can actually weather a downturn for a bit longer. Can they weather it for 10 years? Probably not. But if we stuck in this position for 10 years, then we're in a depression, right? So at some point, globally, we need to restart. We know that if you look at PMIs across the world, they are in recession. Manufacturing's in recession. So this is probably the point you want to start buying these commodity because they are so depressed. I mean, PGMs over this year has lost 50% of their value, right?
Yeah.
Against a backdrop where valuations and the underlying commodity in the next 0 to 5 years is still going to be in demand. We can argue about, you know, whether the prices are going to be 1,100 for platinum or 1,500. But even at 1,100, the earnings will be depressed, but they'll still generate free cash flow. That's a very different position to where they were in the late 90s or the early 2000s, where they were highly geared and they weren't generating free cash flows. So you're able to navigate this cycle, going into this cycle, at least with a stronger balance sheet. I can't tell you when the prices will rebound, but I can tell you that every major vehicle company, every major economy is looking to transition to a greener economy. And that's not going to be one thing. It's not just going to be Teslas driving everywhere. There's also going to be hydrogen. There's also going to be all sorts of other technologies. And that technology does require PGMs. So I think if you look at the globe across the world, right? If you go back, if you plotted a chart of long-term yields, if you look at the early 2000s, coming out of 1999, early 2000s, and you look at US yields and you look at where they are now, it looks eerily similar to where we were in the early 2000s. And if you can cast your mind back, early 2000s to mid 2000s, South Africa had phenomenal GDP growth. Yes, we had a bunch of other stuff, people, low interest rates and all the rest of that. But we've spent, if you plot a chart over 20 odd years, we spent the last 20 odd years the last 10 years unwinding the returns that the SA All Share gave you in the first 10 years of that cycle. So again, you've got to put it into context. The last 10 years globally, we've lived with depressed interest rates, a strong technology sector that's been funded by virtually zero cost of capital. That's coming to an end. You've seen that come through in a lot of companies in China, Evergrande, property companies that have defaulted. So you've got to ask yourself where you are in that cycle. I think if you look at a lot of the SA companies, they've cut costs, they've managed their businesses to the point where even a marginal positive announcement could have an outsized effect on what they return.
Makes a lot of sense. And I mean, part of your presentation, you also said, in so many words, it's all about a business case and earnings growth. But as you mentioned now, you don't know when things will rebound. And I think for investors or intermediaries out there doing portfolio asset allocation, looking at things like SA equity, there's no doubt that SA equity, from a valuation perspective, offers a hell of a lot of value. I agree with you. The rand is too weak. The dollar is too strong. It can remain on those levels for a little bit longer. Who knows? But if we look at SA equity and want to allocate to that, do we need to wait for a catalyst, or what can that catalyst be for that value to unlock? And is that something you can see coming or plan for?
It's $1 million question, Eugene. If I could tell you what the catalysts were, I'd be sitting on a beach somewhere. Look, you always know these things in hindsight, right? I guess the point is no one's going to time this thing, right? We don't know if the PPI number that comes out in the US this afternoon surprises to the downside and suddenly we've got another rally on our hands, right? So I guess for IFAs and people looking to allocate money, the point is you're never going to time the bottom, but at least you want to slowly allocate. It's all about compounding. If you think about what you want to do over time, you want to compound consistently over time. So if you, for example, if you've made a 30% return, there's no harm in saying, well, I'm gonna compound, or I'm gonna buy something that could compound at 10% and take some of that excess return out of what I've just generated. But to hold on right to the end, and then, because what happens in human nature is like it falls 10% and then someone says, okay, I think it's going to go up. It falls another, before you know it, you've lost what you've made, right? So I guess what you're trying to do is you're trying to position ahead of that catalyst, because no one's going to tell you, no one's going to ring a bell on the day and say, okay, now's the time to buy. If I told you today, what do you think gold companies have done year to date? Yep. Over 12-month period, Gold Fields has done 33%.
Good example.
Right? If I asked you 12 months, over a 12-month period, what has Truworths done? Similarly, 34%. It doesn't feel like it. It feels like a terrible thing to do, but it's done over 30%. And it's still trading at an 8 multiple. Right? So often the narrative and the sentiment actually messes with our minds
Mm.
because it creates fear. And again, we've got industries that's been developed around this. The whole, I mean, Bloomberg, e-news, all these things, they tell you the same story, so they create the fear, right? So often you've got to kind of put that aside and look at how am I going to generate returns. I mean, Truist is a good example. People will tell you it's a terrible business, but 34% and it's still trading at an 8 multiple with a 7.5% dividend yield. I'll take that.
No, exactly. And I mean, the point you made, you can't time these things. If you know there's good value, and you know that value is going to come through sometime, definitely a good idea to look at it. And it's always that relative game. What else can you invest in? And if the other stuff appears to be very expensive, then maybe definitely something that should be considered. But on that point, when you speak to things like risk management, how do you avoid value traps? Companies that looks very attractive, good PEs, maybe a good divvy yield, but they just can't seem to unlock a lot of that value. How do you avoid that in your risk management process?
Good question. So we spend an inordinate amount unpacking the strategy of the business, management. So we spend a lot of time, like if we find companies that are showing a lot of value, we actually spend the time meeting management, speaking to them, listening to them. We've walked away from probably about 3 or 4, if not more, companies that screen extremely well for value. But when you speak to management and you dig through the financials, there's a lot of stuff that kind of leave you uncomfortable. So it goes back to that first slide. You can't simply buy a company because it's trading at a 7 multiple. You got to look at what are they doing? What do they do? What's the balance sheet? What's the strategy? Are they going to, is this earning sustainable? So can you wait for the turnaround? I.e., are they going to generate the same earnings? So they can have flat earnings, that's fine. Are they generating cash flows? But if a company is generating earnings that is going to go negative, then even if it's at a 7 multiple, it's not cheap, right? A classic example of that is Bright, right? A couple of years ago, Bright was a wonderful business. Everyone thought this is a wonderful business. But if you unpack the businesses that sat in Bright, it generated very little cash, right? And then you look at the management structure that sat on top of that, where the management was incentivized ahead of shareholders. You actually got a very poor mix of sort of incentivization alignment. So we steered away from something like that. And it's very similar to what you see in a business like Naspers and Prosus. I mean, the management have made an exceptional amount of money on an investment that they made 20 years ago, right? So if you look at the likes of the current management, they're trying to unlock value on Tencent on an investment that they haven't made, but they've made hundreds of millions of dollars, not rands, in terms of remuneration for investment that they never made. The stuff that they've done has actually been value destroying, right? So you got to understand what you're buying, Eugene. It's not a comfortable conversation, but it's really that's the only way to look at it.
But that's why we employ managers like yourselves to do all that work on behalf of our clients. Very interesting, your property allocation sitting at about 11% at the moment, as you showed on your asset allocation. And again, if you just look at the tally every day and you on the ground, the feel around you, everybody is still dodging SA property. But we know valuations of SA property are massively attractive. Are you very specific in terms of what property you hold? And maybe can you use an example of why such a big allocation to SA property at the moment, given the feel that we've got in the SA market?
Yeah, I love it when people are negative, which means that no one loves it. The unloved are wonderful counters if they can prove their resilience. So we've got big positions to redefine and growth point. Let me talk about growth points because it's probably the one that most people can relate to. Massive property across all sectors. So everybody knows corporate is a mess, right? Vacancies are a big issue. But the retail portfolio is actually very well managed. The waterfront that they have a stake in is extremely well managed. It's actually beginning to see positive reversions. They've already pointed, so Growth Point has already pointed that next year, so the next distribution will be down 10% on this year's distribution, right? So even if it's down 10%, your forward yield is about 11%. And the reason it's down 10% is because the rolling effect of higher interest rates are coming through in its earnings numbers, right? Now just think about that. If we are at the top of the interest rate cycle and into 2024, we get cuts to that rate cycle, it means that your base effects will start having a massive positive effect going forward, right? So your yields, you're buying a yield now that's probably close to about 10.5 and 11%, but your yield 12 to 18 months out is probably going to increase just by the fact that interest rates will start to drop. And I'm not talking about, 3% drop in interest rates, but every 0.5% has a multiplier effect through the income statement and the distribution. Now you couple that with the fact that you're paying 50% of book value for these companies. Now, remember, book value is also calculated by the revenue stream or the rental stream divided by the cap rate. The cap rate is effectively the yields. So if interest rates are coming down, the yields will come down and the cap rates go up. So the NAV will increase as well. So your forward discount is not 50%, it's more like 60%, right? So the question you've got to ask yourself is, do you think all property will be devalued by 60%?
Unlikely.
So, unlikely, right? So you've got a couple of very strong positive numbers that could be very powerful in the next 6 to 12 months. Now, I say 6 to 12 months because I can't tell you whether it will happen end of this year, early next year, but I think we're at the top of the rate cycle. I think the next move is flat and probably lower in SA and globally. But I can't tell you it's January next year or March next year. So we're buying companies that when the first sign of that happens, you'll actually get a massive positive re-rating because the fundamentals are so strong.
Sounds very attractive indeed. Very quick question from the audience, and it speaks to your valuations in the portfolio. What is your average PE and your average divi yield at the moment, more or less?
So average PE is probably around 8 times, and divi yield will probably be about 6.5, 7 times.
Very high indeed. Very, very last question, Substance, and it's unavoidable. It speaks to, again, we're back to macro. I've been flooded with calls the past 2 or 3 days, especially, the whole escalation with Hamas, Israel, what's happening there. But just from your perspective, I mean, does these kind of events have any kind of impact in terms of how you see the portfolio, how you see the world, the SA market, and does that at all influence your positioning?
The short answer is no. I think the reality is that these wars, when the Russia-Ukraine war happened, oil spiked and then came all the way back. The war's still happening. When the Hamas and when Israel invaded Gaza, oil spiked 3%. 3 days later, oil's back to where it was. So these events happen. I mean, the conflict in Palestine has been going on for 70 years. So it's not just started. It's been flaring up forever. Yes, this is a bad round, and yes, loss of civilian life is a terrible thing across anywhere. But you can't manage your portfolio based on these things because they have unintended consequences in the strangest of places. So let me ask you let me give you a strange thought. The US Senate has lost the Speaker of the House. They're going on vacation soon. They need to pass an expropriation bill. If they don't have a Speaker of the House, they can't pass an expropriation bill. They've passed a short stopgap measure for the next 45 days. If they need to supply Israel and the Ukraine with more ammunition, They need to spend more. You know the Republicans don't want to spend more. So the unintended consequences, what if there's a stalemate in that sort of process? So the unintended, what if there's a stalemate there and you have a shutdown of the US government into November? No one plans for that as a base case because the US will pay its debts. But it does mean that their fiscal position becomes more constrained because they'll just become more and more indebted. And higher yields don't help the issuance of debt that they need to do because they need to issue it at a higher rate. So the second round effects of all of this stuff is that there'll be less money in the system flowing through. But you can't really, well, we don't really manage our portfolio by saying, well, there's a war breaking out, oil's going to spike because they're going to bomb Iran, for example.
Can't plan for those kind of things. And I mean, back to the base case, look at company valuations, look at earnings growth, because that's where your clients make money at the end of the day. Safs, we come to the end of our session. It's been a very insightful conversation. To our audience out there, the Vunani funds are available on mostly all the platforms. And if you do look at or consider allocating more to a good opportunity, the SA equity market, Vunani BCI equity fund, I think definitely a strong consideration, especially given your background and phenomenal track record in managing these kind of opportunities. Safs, thank you so much for joining us this morning. Looking forward to speak to you in the very near future again, having you either here or at our live venues. To our audience out there, very quick reminder, next week, Wednesday, we've got Fairtree Asset Management on low equity, the 18th of October, and we'll retake these conversations. Safs, again from our side, thank you so much for your time this morning. I'll speak to you again very soon. Thank you.
Thanks, Eugene.